On June 12, 2026, the trading floor erupted as a new digital ticker symbol, SPCX, hit the boards. Space Exploration Technologies Corp. Priced its initial public offering at $135 per share, pulling in up to $85.7 billion in gross proceeds. The stock opened at $150 and surged immediately. Over the next 4 days, an intraday peak pushed the firm's total market capitalization past $2.9 trillion, before a broader sector sell-off settled the price near $165 a share. That $2.2 trillion market capitalization makes this the sixth most valuable listed entity in the United States. However, this $2.2 trillion price tag creates a market paradox. The valuation appears disconnected from the company's established identity as an aerospace manufacturer. In the fiscal year leading up to the IPO, the company brought in $19.3 billion in trailing revenue. During that same window, they reported a consolidated GAAP net loss of nearly $5 billion. This bar chart breaks down the financial strain behind those numbers. Against that $19.3 billion in revenue, we see deep negative columns representing a $4.9 billion net loss and a $13.9 billion free cash flow deficit. To cover that gap, the company accumulated over $30 billion in debt. Dividing that $2.2 trillion market price by the $19.3 billion in sales yields a price-to-sales multiple exceeding 110x. For context, typical manufacturing firms trade at a multiple closer to 2 or 3. A sum-of-the-parts deconstruction reveals the scale of this gap. As a traditional defense prime, launch infrastructure justifies a $75 billion valuation. Adding the connectivity telecom utility adds roughly $220 billion. Together, rocket and satellite fundamentals sit at $295 billion. The camera zooms out to show the $1.9 trillion void remaining between those fundamentals and the $2.2 trillion market price. Because the core aerospace and telecom businesses mathematically cannot explain this price tag, the remaining valuation rests on a pivot toward massive, newly integrated infrastructure assets. In February 2026, SpaceX executed an all-stock merger with xAI. Because both entities were under common control, GAAP accounting rules forced SpaceX to retroactively consolidate the financial statements of xAI and the social platform X. The physical centerpiece of this integration is located here, anchored by this glass pyramid in Memphis, Tennessee. This is the Colossus Supercomputer Complex, a facility housing 555,000 advanced GPUs. Operating this hardware creates a severe financial strain. In the first quarter of 2026 alone, the artificial intelligence segment burned through $7.7 billion in capital expenditures. This scale shows the weight of that spending. That single $7.7 billion block of Q1 AI expenditures tips the scale against the combined capital spending of the entire space and connectivity divisions. That rate of cash burn threatened to derail the public listing. To stabilize the balance sheet, the company overhauled its supercomputer monetization strategy. In mid-2026, the company transitioned from using its supercomputers for internal training to acting as a digital landlord for the AI industry. In May, Anthropic committed to renting the Colossus One data center, agreeing to pay $1.25 billion per month for the compute capacity. Google later signed a contract to lease capacity at the Colossus 2 facility for $920 million per month. A third deal with Reflection AI for advanced chips secured an additional $150 million in monthly revenue. These 3 agreements converted a bleeding hardware portfolio into an $80 billion high-margin revenue backlog, positioning SpaceX as the physical backbone for AI infrastructure. By June, SpaceX had integrated 3 distinct businesses into a single entity: orbital launch, global connectivity, and frontier AI compute. However, short sellers question whether an $80 billion compute backlog justifies a $1.9 trillion valuation gap. The structural critique is that these supercomputer deals are essentially standard equipment leasing contracts. Hardware leasing is a cyclical, low-margin industry. This makes it a volatile foundation to use when attempting to offset the company's massive underlying debt. Market bulls are looking past the current balance sheet toward a projected $28.5 trillion total addressable market by 2035. They expect orbital transport and global satellite connectivity to become the physical layer of the future global economy. That optimism is supported by a sovereign defense moat and the CEO premium investors attach to Elon Musk. Ultimately, the company is speculatively valued. Buying at $2.2 trillion represents a massive bet that one single company will simultaneously monopolize orbital transport and the physical infrastructure of the global AI economy.